Financial advice is omnipresent these days. No matter the source, it cannot be trusted almost always. I guess any one of you heard this sentence 100 times. This is no financial advice. Please contact a financial advisor if you seek help with your finances. Today I will teach you why this is very bad advice and why you should not listen to most financial advisors. In addition to that, I will also look into a lot of other financial advice or non-financial financial advice and show you that almost all of that is rubbish too and should be disregarded. Hello and welcome to Finance with Axel. You might have already guessed it, but I am not a financial advisor, but you should still listen very carefully to the information contained in this video. It is well documented that on average you will have the best performance on the stock market using a so-called buy and hold strategy. You basically buy a well-diversified portfolio and hold onto it forever, or at least for a very long time. Meaning that you buy low-cost index funds and or ETFs and basically forget about it. This lazy approach will outperform the majority of other market participants. I will link 2 other videos in which you can learn more about this approach. But that's not today's topic. We will talk about financial advisors, traditional finance media, and finance and crypto influencers. Don't trust any of these, as most of them are giving bad advice and are in a conflict of interest too. The only one to be trusted is me. Joking, trust nobody. The only one qualified to make financial decisions for you is yourself, since you are the only one without a conflict of interest. Okay, let's elaborate on this, starting with financial advisors. Why can't these specially trained and educated people be trusted? This is because your financial interests don't align with theirs. Often financial advisors are paid on a commission basis, which means that they are not trying to sell you the best product for your needs, but the one that maximizes their commissions. There is a lot of evidence that high fees and active management is not in the best interest of investors. Nevertheless, exactly these products are often advertised and sold. Not coincidental, the commissions that the consultant collects for these products are often very high. Studies have also analyzed this issue and concluded that financial advisors are influenced by commissions. There is no fiduciary duty making things worse. Usually consultants cannot be held accountable for bad advice. As long as the advice is suitable, it does not have to be in the client's best interest. It would actually be suicidal for an advisor to suggest low-cost index funds and buy and hold approach. There is scientific evidence that this is the best strategy, but this approach would cause the advisor to not earn anything or very little compared to suggesting expensive actively managed mutual funds. This is because these products don't pay commissions. In addition to that, the advisor normally is paid for getting active, for example, for restructuring the portfolio from time to time. Again, collecting commissions. This would all be gone if he would instead invest passively. He would also probably lose his job if he is not making the employer money with his advice. You see in this dramatic example that he would act against his own interest if he were to recommend the optimal strategy to his customers. Often commissions are blamed for the flawed advice given. However, there are also more innocent explanations for bad advice, which still leads to the same result in the end. You will get bad advice. Even well-meaning financial advisors might give bad advice because of the following reasons. Barriers to entry to become a financial advisors are often low, meaning that many advisors lack the fundamental financial understanding necessary for their job. Their bad attempts of giving good advice could be just misguided. Actually, this seems to be the case quite often. This theory was checked by a paper called The Misguided Beliefs of Financial Advisors. This study looked at the portfolios of advisors and also those of their clients. If the advisor holds low-cost index funds while selling high-fee mutual funds to his clients, he is clearly biased and not doing his best, just trying to optimize his commissions. If he holds the same assets, he might just not know better. It was found that often the portfolio looks the same for the advisor and the client. Often the advisor is therefore not intentionally doing harm, but he is just bad at his job. This leads to the same result though. The customer gets suboptimal misguided advice and a lower portfolio performance. What conclusions should you draw from this information? Get financially educated yourself. It's way easier than you might think. By employing an easy-to-use buy-and-hold approach with low-cost ETFs and index funds, you don't need much expertise to make it work. The time required to maintain your portfolio is also slim. If you still don't feel up to the task, you should at least choose your advisor wisely. Make sure he is not paid based on commissions but by the hour. Also look for someone with advanced financial education. He should also know about the evidence that low-cost index funds and ETFs are a sensible solution for almost everyone. Ask your advisor what he thinks about ETFs and index funds. The right answer is that index funds and ETFs are the most sensible way of investing for most people. Moving on to the traditional finance media. I think it's not just me. I have never seen low-cost ETFs or index funds being pitched in stock market news or financial articles. Instead, it was mostly about market timing, profit-reducing trading, or the latest top-secret stock tip, which by now could no longer be too confidential if it has already progressed that far. The strategies that are being promoted are those that have been proven to reduce our profits on average, namely the lack of diversification and active investing with a lot of back and forth in the portfolio without good risk management. Remember, folks, time in the market beats timing the market. And a lot of back and forth trading will empty your pockets in the long run, or at least harm your expected returns. This is because of the fees payable. Trading also is not tax efficient in most countries, while hodling is. We are again confronted with a conflict of interest. The media wants to increase their circulation or get maximum clicks. Hardly anyone is interested in low risk and boring investing with ETFs. That's why it's not addressed. In addition, the topic is also quickly worn out and one would have no more suitable material. However, if one reports current stock news and sensational events or hot stock picks, for example by presenting the next alert 10-bagger, one can be sure of a lot of attention and the survival of the newspaper. Although bad advice is given and bad strategies are promoted. Moving on to finance and crypto influencer. All the things said for traditional media are also true for them. They usually want the biggest attention possible. Not necessarily the best advice gets the most attention. On top of that, many of the influencers are either incompetent or only concerned about their own well-being and not yours. Bad advice is not only given because of incompetence, but it also often happens that bad investments are promoted for personal gains at the expense of gullible viewers. I'll give a few examples. A YouTuber buys a shitcoin with a low market cap to later chill this to his huge audience. He basically creates a pump and dump, being able to get in first and later dump on his viewers who are left holding the bag. Often influencers also recommend NFTs, stocks or cryptos without disclosing that they don't invest themselves. They are paid chills, getting paid for promoting something without disclosing their real motive. Very blatant negative examples are when YouTubers receive money in the form of NFTs or cryptos and immediately sell while they promote the coin or NFT to their unsuspecting viewers. Anyone who sells overpriced courses coupled with unsustainable promises is also to be considered very dubious.
Knowledge.
The most despicable are people who do technical analysis. Usually these also offer overpriced courses. In addition, they often have cooperations with brokers and exchanges. Often they pretend that they can predict the price by looking at the chart and drawing a few lines, which they obviously can't. People unfortunately still fall for it. They sign up to the brokers recommended and follow the lead of the influencers in question by placing leveraged bets on the suggested trades. The influencers now earn money from the high fees that are due for such trades. These guys don't care if you make money or not. All they care about are the commissions generated. They just want to get more people engaged, and those who are already there should continue trading and make a lot of turnover, as that's where the money comes from. These bets are highly profitable for the broker only. Almost all traders will lose all their money in the long run if they continue trading. This is like playing in the casino. You might get lucky once or twice, but in the long run, you will lose all your funds. Making matters even worse, people will often get addicted to this highly addictive form of trading. So, viewers and fans are driven into ruin out of personal greed. It is not a win-win situation where a great product is advertised that the customer then later appreciates. Instead, he is driven into an addiction that only benefits the influencer and the trading platform. This is all the more shameful because many influencers have a relationship of trust with their audience. Many of the viewers trust the content creator like a good friend and expect good suggestions and do not see through the true intentions. All influencers should be aware of this when they produce harmful content that is only designed to increase their personal wealth at the expense of their fans. If then advertising is not even marked as such, in my opinion, one can even assume a fraudulent intent. My intention was not to make all people universally look bad. Certainly, there are also some positive examples out there, both among influencers and also in the financial advisor category. Nevertheless, there is often a conflict of interest, which either consciously or subconsciously means that the advice given is often not in your best interest. Always be aware of the biases. Be careful. Trust no one but yourself. Be especially suspicious and question the intention of your counterpart extra critical if he wants to sell something. It is best to take your finances into your own hands and not to trust any third party. Always do your own research and verify the information you were given. I hope this information will help you in the future to go through the world more critical and with open eyes. Do not fall for the many scammers and charlatans. If you have learned something, do not forget to share, like, and subscribe. Thanks for watching. Bye until next time.